I wanted to just take a little bit of a look tonight at the similarities of 2008 to today. And I didn't know that there would be any, but I think after you get done with this video, you're going to see that there are. And it's concerning to me because this does hold any value or any truth to it. Then we're in for a particularly difficult time over the next year to possibly even longer than that, depending on how this inflation battle goes. But that being said, looking at the chart here, you can see I've got them side by side. I've got kind of 2007, get my cursor here, 2007 to 2009. And then right here, I've got 2021 to 2023, where we are today. And you can see the decline that we've faced in the last week. These are weekly charts. And so the first thing I notice is that kind of the structure of the decline to this point. We had a drawdown and then a rally. Well, we've got a similar, these are the market tops, by the way, where my cursor is now. This is a market top, and I'll just use some price levels to highlight that. So that's the market top there, if I can. That's the market top there. So we had the structure is just a little discomforting. It goes down, we got a little bit of a rally, goes down again, a little bit of a rally. So it goes down, we got a rally, goes down again, a little bit of a rally. From that second rally, we go down again, then we get a more meaningful rally. From that rally, we go down again, then we get a more meaningful rally. Again, down, then a rally. Same thing here, down, then a small rally. Now, we're kind of, based on this chart, we're kind of right here, in my opinion. If that's true, then we're halfway through the worst of this. Now, I don't know if I'm right. I'm probably wrong, but if my assumption is correct, we're somewhere right here. This is what I think is coming. And the reason I say that is because we haven't seen, if you look at today's market, it's been kind of a slow, methodical, I mean, I don't know if you could call it slow, it's been a methodical move lower. And a couple of things to point out here is we haven't even crossed over the 200 period moving average line. And so at current, we're not below the 200 period moving average. Back in 2008, somewhere about where we are now is where we cross below it. So I would assume in the next week or two, we will eventually make that cross. I would assume with all the bearishness in the market, at some point, people are going to get scared or fearful, and you're going to get this massive decline. Now, I know we had that in 2020, but it was more of an anomaly. That was based on the pandemic. People were scared for their lives and scared, for their loved ones. I think what I'm saying is I'm looking or expecting at some point this serious decline. Now, the alternative is we don't get the fear decline or the scary, fall off the cliff candles here, and we just continue this slow, methodical grind lower. And at some point, we're going to cross over this moving average, and it's going to continue to whatever level down here that it goes to. I hope it's not protracted. I hope it doesn't take us 3 years to get out of this bear market. But we've seen inflation like we haven't seen in 40, 50 years, 60 years, whatever it was, and we're also facing the other side of the coin to the quantitative easing or the Fed's movements to combat the 2008 financial crisis. So we've kind of got two things staring us in the face that neither one of them look particularly good. And so I'm not overly optimistic in the near term for the market. It's not going to change anything that I'm doing. I'm still looking to sell covered calls, sell cash secured puts, continue the cash flow, and continue earning the dividends on my portfolio. But the core value of that portfolio is certainly going lower, as I'm sure many of yours are as well. But with that all being said, let's go and take a look at an article I found. I found this kind of interesting. I just Googled, is 2008 happening again? And so this was an article I found from Forbes. It said, could 2022 be worse for investors than 2008? And the reason it kind of showed up on my radar is because I guess they just updated the article for 2023. But most of the comparisons were made for 2022. As we know, 2022, and as we just saw, 2022 was a rough market and things kind of just all went lower. But if we look through here, it kind of starts off just talking about some of the differences between now and 2008. But what I really wanted to focus on was kind of this the scoring criteria that they looked at and kind of talk about each one of these really quickly. Again, like I've already mentioned, inflation is obviously worse now than it was then. You can see in 2008 there was an actually negative or deflation, I guess you would call that. So inflation is certainly worse, which can't be good, which means the Fed's going to continue to raise rates to fight that inflation. And the more they raise the rates, as we all know, that can impact the equity markets and send them a little bit lower, or maybe substantially lower. We don't know the full effect of how high they're going to raise rates or how far it's going to push stocks down. The stock market was worse in 2008. Yes, that's true, but 2008, if you see here on the chart, 2008 faced that serious fear decline where people just got scared. Everybody thought the market was collapsing or the economy was, and they just started pulling their money out at an alarming rate. And so we haven't had that yet. So to compare 2022 to 2008, yeah, 2022 wasn't as bad as 2008. But again, we haven't had that massive decline. At some point could come, or we just haven't allowed enough time for the drawdown to be fully realized. So in either case, 2022 wasn't as bad as 2008, but if you say 2022 and 2023, is that worse than 2008, or 2022, 23, and 24? You add all those up, that may be considerably worse than 2008. And if you just look at, just on a percentage basis, if you look at this little box that pops up here, from peak to trough, you can see we were down about 57%. Well, if you compare that to today's market, you can see peak to trough, we're only at 27%. So if we continued all the way to 57%, we'd be somewhere down here around the 200 range, give or take. We're about halfway, which is why I said I feel like we're waiting for this other shoe to drop. And once we get that other shoe to drop, then we can start to recover and get over this. But who knows when that shoe will drop, or if it will drop, or how long it may take to drop. And that's the bigger problem for me, is if it's gonna fall off a cliff, let's fall off a cliff. But I feel like the way the Federal Reserve, or the way we're fighting this inflation battle, is I feel like it's going to be longer and more protracted, and certainly be a lot more uncomfortable. Getting back to this article, the market was worse in 2008 than it was in 2022, but this should have an asterisk by it, because we don't know when the final comparison should be done. The bond market is worse now. I know that because I have some bond investments. That being said, there is a higher yield on those bonds, so we'll just, I guess, time will tell if those yields are going to make up the difference here. Dow Jones real estate index was worse in 2008. That's true, but when you look at how astronomical the rise was in houses in 2020 and really maybe 2019 to 2021, 2022. So just to see how astronomical the rise was there, I think this 43% is going to pale in comparison to what this final number is in 2022, 23, 24, whatever the case may be. Gold is certainly worse in 2022, and we of course had crypto mixed in there, and I'm not going to talk about crypto. I have some investments in crypto, but largely I don't like it. I believe it's just pixie dust and don't really want anything to do with it. That being said, I want to look kind of at the closing arguments. It says, judging by our highly unofficial scorecard, 2022 has been worse for investors than 2008. Well, that's not particularly good, because I feel like 2022, we didn't even reach the halfway point between now and 2008. So if 2022 was already worse than 2008 for investors, and we're not even at the halfway point, I don't even want to know what the rest of this downward movement in the market is going to feel like. Anyways, I thought it was worth looking at. Just be careful out there in the market. Certainly make sure you're doing your research and that you're taking time to understand the investments that you're making. But that's it for this video. Until the next video, guys, God bless and take care.